Hey, this is Sasha. Thanks for joining me here for another episode on Let's Talk Stocks. Today we're going to take a look at how to buy a call option. We're going to do it step by step, so stay tuned. All right, so here we have our TD Ameritrade or Thinkorswim platform. You can see here I have some of my positions right here. And then here's your profit and loss. So that's kind of the baseline. We're going to take a look at mostly the trade panel and the analyze panel. So first off, you got to decide, where do I want to buy a call option? And the whole point behind buying a call is you're expecting that stock to head higher. If you're just buying a call, you're looking to go ahead and buy that call for the right in the future to own the stock. Now, most people, they don't go ahead and own the shares or purchase the shares. Instead, the value of the contract becomes higher. So for example, if you have a purchase order or maybe some kind of deal made where, hey, I can go ahead and get next year's iPhone or next year's product for a certain price, let's say it's $1,000. Well, instead of going and picking up that phone and then reselling it for maybe $1,500 if, you know, everybody wants it, or if it's like a hot item for the Christmas season, what you could do is really just sell that ticket to somebody else and they could go ahead and pick up and buy that phone. Anyways, with that being said, let's take a look at buying a call option. So if I'm looking at a certain stock, we're going to choose Facebook in this case. It's just one of the easiest and quickest to go ahead and put a call option on. It's got only 2 characters, so I'll go ahead and go to this trade tab right there, and I'll go ahead and type in Facebook and pull that up. Now here in this option feed area, or the trade area, we have our last price, net change, bid, ask, size, and then under that you have your calls and your puts also on the other side. So we have the puts over here and we have the calls on this side. Now normally when you buy a stock, you just right click, buy, and then you choose the number of shares here that you want. You know, here I have 500 shares listed, and I could go ahead and right click, confirm and send, or I could hit this confirm and send button over here as well. So I could go ahead and do that, and then it'll pull up some option buying power and that kind of stuff. What I also like to do is sometimes right click and analyze the trade. And when you analyze the trade, this is the way the profit picture goes. So basically, if I buy 500 shares of this stock right here, right now, well, if it goes up to, let's say, $95, well, I would make $1,505. And that's why I like this Analyze tab, because it shows you, hey, if that stock price continues to go, you make more money. So the way that this works is, here's your stock price on the bottom. So obviously, if the price continues to go up, you know, all the way to $199 or $200, well, you make more money, right? If you buy something for $1, you sell it for $200, you make more money. And here's your zero line. So this on the left side is your profit and loss. So this is the amount of money you're making. So really, as you can see from the zero line, well, if it continues to go down, I'm losing money. If it goes up, well, I'm making money. And options work in a very similar way. So what I could do is go in and go to the call side, and I get to decide, well, how many days out do I want to go ahead and make this purchase? Now here, you'll get to see all the days till expiration. Options expire. They have certain amount of time left, just like insurance premium. So this one right here, you could see is 2 days until expiration. This one has 9 days. This one has 16 days, 23 days, and 44 days, and so on. Some of these have very long expiration days. You can see some have 807 days to go. So if you really, hey, I want a lot of time premium, I don't want to buy the stock, I just want to deal with the option. I don't want to pay a lot of money. So the closer you are towards expiration, let's say 30 days and less, it expires really quick. 60 days and less, it still expires quick, but not as fast. And that's called your Theta Decay. Now, if you start going further out, like let's say 100 days, 300 days, there's not as much Theta Decay. So what you could do is open up and say, okay, well, I'm interested in about 100 days, maybe 200 days option contract. So I'll open up this June 2020. So it's 226 days out. And here's all your contracts, and you get to choose the strike price. Now, the closer you are to the money, or at that money, at the current price, because right now that stock is 191. Well, if you get one option contract at 195, you're very close to the price. So you'll pay a much bigger premium. Here's your cost right here, bid and the ask. You'll pay much more at this price at 195 than you will of, let's say, 255, because, well, for that stock to go up another 60 points, it's not as likely. So in that case, well, you have a much cheaper contract. So for example, I could go ahead and say, okay, well, let's check out something at the 200. I'll buy, right-click, buy a single. Now you could also just go ahead and click the ask, and that'll pull it up as well. I like to just go ahead and click anywhere and then go buy a single, and now it pulls it up, and you can right-click, analyze that trade in the same way we did earlier with the stock. And now I can spread it out. So here you have two lines. One is at expiration, which is your green line here. In my case, you could, of course, change those colors. And the other line is today, the white line. And with time, you have your theta problem, which is $4. You're paying $4 a day in a way if that stock stands still. Now, you can see and move that time date forward with time. That profit and loss right over here, okay, will continue to get larger. The loss will continue to get larger because if the stock doesn't move, you lose money. So that's the thing with options. But if it does move, you don't have to pay the stock, and hey, you could go ahead and profit from the move. So I could go ahead and continue to just sit on it for a while rather than owning the shares. Now, to purchase this, all I got to do is right-click, confirm and send, and that would send that order kind of in. So let's go ahead and put that in. You can see it gets in pretty quickly. So here's my issue here with this one. So if I go ahead and stock stands still, I lose money. Stock pulls back, I lose money. Stock goes up, I make money. And it has to go up a little bit because I have to counteract the loss in the theta or the loss in the premium value. Okay, now if I would have went out a further option instead of a 205, because right now this one is a 205 call and the current price is 191. If I would have went further out, I wouldn't have to pay as much. Now this one I paid 1,270 for one option contract. If I go further out and I'll go ahead and let's say go to the 280, so that's pretty far out. Buy a single, right click, analyze the trade, and now I'll uncheck this one, and you can see that, hey, I'm only paying $91. Why 91? It says 91 cents over here. Well, remember, each option contract deals with 100 shares, so you multiply this times 100, so that's why it's $91. And that's why the same thing with this other one, instead of 1270, I paid 1270, it's 1,270. So in this case, it's $91, but I'm risking $91, but the stock's gotta explode. So the chances and probabilities are not really in my favor because it's really far out, right? So I gotta go ahead and right click, confirm and send if that's what I'm interested in. So I go ahead, I get filled into that contract, and now you can see it's gotta really shoot up and go up. And remember, each day I'm losing a little bit of money, but you're looking for a real big explosive move. So that's kind of the way it works, and that's how you could go ahead and choose it on a basic level. Obviously, there's more advanced option strategies, but really you could say, hey, well, do I want to pay more and get it a little bit closer? And in that case, if it moves, I make quite a bit of money, and all of a sudden it starts moving more like a stock. If you go further out, well, so far it's a slow move, and then the stock really's got to move a ton, but I don't have to pay a lot of money. I could just pay like $80, $90 and just take in like a little lottery ticket and see if that stock really explodes. It could be due to earnings, some news, whatever the case may be. So that's how you could go ahead and think of it when choosing an option. Now, to get out of it, you could get out of it early. You don't have to hold it until expiration. There's nothing that says you have to hold it till expiration. I could just go ahead, right click, analyze the trade, and then go ahead and confirm and send, because you can see this would flatten out my curve. Again, I could also go right here to my main page and choose which one I want to go. You can see it's 226 days out. And the one I'd want to sell out, let's say this one, right click, analyze closing trade, or create a closing order. So both of those will work. I just go ahead, hit confirm and send, close out the trade, and boom, now I'm kind of done. And out of that position, I could do the same thing. Instead, I'll just do analyze on this one, right click, analyze the trade, get rid of this other one, and let's just tick a couple of these over here. So all I'm doing is tick marking, in this case right here, this one, and then this one together, and you see the curve, it'll just flatten that out. And because it's flat, that means I'm closing out the position. I could get out of it 10 days from now, a minute from now, an hour from now, or 200 days from now, or I could let it expire. I just right click, confirm and send, and then I'm out. So in any case, that's how it works when you're buying a call options, at least the basics behind it. if you're looking to trade options in the TD Ameritrade platform. That's the simple form of it. Now there's more advanced things you can do with options. I'll just show you on something like this. Here's a Shopify. This is a double butterfly strategy. Let me go ahead and reset. And you can see this strategy right now on a double butterfly on a couple of contracts. It's basically 3, 6, and 3 spread, 2 of them, almost like an iron condor. If you never heard that term before, today it's up $395 or almost $500 between multiple days. Let's take a look at another one. Let me see what else I have in here. Netflix trade right here. This one is up, I believe, looking at it, it's up $44 for the day, but only $15 for the whole position. So it's not really profitable. I was completely wrong on it almost. It didn't stay or hang around right here, but it's still doing fine. And still holding kind of that position. Here's another one. Here's one of the bigger ones. The longer term hold that I have is just the overall market. And here's the S&P, and you can see this is kind of more of a diagonal. So this is, again, more of an advanced strategy. And you can see right here, this is up about $3,000 in a handful of days on about 6 contracts plus 3, that's 9, 10, 11. So about 11 contracts or so. And this one makes us a positive theta. So in either case, you can see you can get really fancy, really advanced with options if you want, or you can keep things really simple like buying a call like I just showed you. So whatever works for you, by all means, go for it. If you want to look at some of these more advanced strategies, I definitely check out our website at rise2learn.com with the number 2, rise, number 2, learn.com, or check out our Traders Fly website as well. Anyways, thank you so much for joining me. You can also check out those websites by clicking the link over here, signing up to a newsletter list, and learning even more about trading options the right way. But if you just want to hang out on YouTube, no problem. Hit the button right over here, the face icon, and you'll be subscribed to our YouTube channel. Thanks again, and I will see you next time.